The future of IPOs, streamlining process and enhancing evaluation with technology. Please join me as I welcome on stage our moderator for the session, Shri, Ashwani Bhatia, whole-time member, Securities and Exchange Board of India, SEBI. A huge round of applause. A very good afternoon to you, sir. Warm welcome. Please join me as I call up on stage our speaker, Mr. Ganeshan, Murugaiyan, Managing Director, Head Investment Banking, BNP Paribas. A very good afternoon to you, sir. Next, we have Mr. Vijay Chandok, MD and CEO, ICICI Securities. Our third speaker for this panel, we have Mr. Vishal, Kampani, Non-Executive Vice Chairman, JM Financials, joining us. Can we have a huge round of applause for him? So looking forward for this session, the first panel. Ladies and gentlemen, with full-on energy, here we go with the final day of Global Fintech Fest. Over to you. Thank you so much.
Thank you very much, and a very good afternoon to all of you. We're in the midst of a good run as far as the capital markets are concerned. We've had good raisings. Just to give you some perspective on the numbers, in 2023-24, around 2 lakh crores was raised in the primary issue of capital, and another 8.5 lakh crores on the debt side. So this afternoon, we are not going to talk about debt. We'll be discussing more the equity raisings. And so far, this year, in the first 4 months, we have already crossed what we had collected in the whole year 2023-24. So the primary issuance capital has already exceeded 2 lakh crores. Last year it was 1.97. So huge numbers. In a way, it reflects the opportunity, it reflects the growth. And obviously something is much, much different from the earlier cycles that we saw. And the earlier cycles were the early 90s, mid-2000s, and of course, this cycle that has started post-COVID. So I'll start from the other end. I'll start with Vishal. Vishal, as you know, is with GM Financial, one of the oldest investment banks in the country. And of course, they have a good ringside view of the capital markets. So Vishal, maybe you can start and give your perspective to let everyone understand how is it different this time? Are you stressed? Are you happy? What are the challenges? And do you think investors need to be happy? Do they need to be careful? Do they need to be diligent? Whatever you have on your mind, I think the audience will be very happy to understand your perspective.
Thank you, sir. Thank you for the opening comments. I think from a market perspective, I'll start with 3 broad observations which have been, I would say, game-changing for India, which I have not seen in my 27-year career in capital markets. One is a very serious emergence of domestic capital. In India, normally, if you go back even 6-7 years in history, without having a large FPI, a foreign portfolio investor book, it was difficult to get an IPO through. And that game has completely changed. Today we see the mutual funds, the domestic insurance industry, as well as the emergence of HNI and retail money, which is the cornerstone of almost every single IPO that is getting done. And they are the drivers, the key drivers of demand for equity issuances. So that is one. Second, we always had cyclicality in breadth of industry. You would have tech as a sector doing very well, financials as a sector doing very well, industrial sector doing very well. And rarely did we see issuance happening for more than 3 or 4 sectors in a year. And now we see a tremendous amount of breadth where almost every industry is growing. And this obviously is the impact of the country doing very well. And we see that effect across industries and across issuances. And third important factor is the offer for sale and the block trading business, where it is no longer a taboo, if I may use that word, for promoters to sell and exit their holdings in companies, and those are also getting absorbed by the markets. And this is, in a way, largely driven by private equity, the emergence of private equity, where they are pumping in growth capital into the country. And of course, with the capital markets being very robust, they're also getting exit opportunities, and a lot of promoters are feeling the same way. To your question, sir, I think we are very excited. The markets are very rewarding. Investors have made, on average, 30% gains in IPOs last 1 year. Last 2 years, that number is around 23%. So it's been a very rewarding investment. But having said that, one always has to be cautious, because there is no doubt that we are in a roaring sort of bull market. Few of the spaces, like the SME space, one has to tread with caution. Many quality companies could be IPOing, and the diligence standards in some of those companies may not be as great, so one has to be very careful. I must say that a lot of the investors who are investing in IPOs today may not be even reading the offer document. The offer document has a lot of information on companies. One must read those documents. A lot of investors just rely on research. Research only talks about valuation of a company. It does not give you the full overall picture of a company. And the amount of work SEBI has done over the last couple of years in strengthening the amount of disclosure that you get through an offer document, that really, gives you a full view on who you are investing into. So, and, all these practices somehow take a backseat when the markets are roaring. We are, as an industry, having a problem in terms of people, because the growth in issuance activity is so high. And therefore, some of these things, in terms of making sure the offer document is best in class, on the buy side, investors reading offer documents, making sure they are understanding the company not only from a valuation perspective, these things tend to take a back seat. And this is one of the areas when one needs to be careful and, of course, be diligent. But yet, having said that, the markets are very well. They are in the pink of health. India seems to be, the flavor of the season across the world. FPIs have seen a little bit of rotation, but I think longer term, even they are betting on a lot more money into India.
So Vijay, the next question to you, in addition to what I had asked initially, obviously some risks have been pointed out by Vishal. Would you hold to the same view? And we talk only of IPOs most of the time, right? But another form of capital raising is FPO. Finally, that money is also used in capital formation, getting new industry in and all. And the trend over there, number one, and is it the same industry, or are these different industries? And do you also get the same challenges on people, on investors, and are you happy with the domestic side, which Vishal talked about?
Yeah, thank you, sir. Thank you for the opening comments, the question, and thank you to the organizers for having me here this afternoon. I'll just expand to the earlier one and then come to the specific point that you said. I think in addition to the areas that Vishal spoke about, two areas that specifically I feel this time it's a little different from the past runs that we've seen is it's on the back of very strong earning momentum and of companies. And it's on back of virtually, I would venture out to say, probably strongest India macros that we've seen in a long, long time. Whichever macro you want to pick, whether it is inflation, growth rate, relative performance of the currency, relative performance of the economy, the current account numbers, fiscal numbers, all of them are virtually at all-time highs. So it's on the back of fundamentals. It's back of strong earning momentum. And let's not forget, in the last few years particularly, I think the regulators have really changed the market in terms of transparency, and I think Vishal did touch upon that. The way information gets disseminated through the MIIs, education to a large extent has been an agenda which has been driven for several years, and I think it's beginning to show some head and some color there now. So it is on the back of a lot of efforts of the regulator which has given the confidence for the investor community, be it foreign, be it domestic, to come and participate in large numbers and put money to work with fair amount of confidence that the whole system is well regulated. I think that's also played a very, very important role. I think if these two things, I would certainly believe is a little different from the past. Indeed, I think from where the markets are, one would probably say that it's been priced to virtual perfection. So risks are looming around factors, particularly global factors. And with respect to the opportunities for corporates to raise money, I think we are seeing all kinds of colors: IPOs, FPOs, IPOs mixed with OFS, which is offer for sale from the promoters or the Ps, primary issuances from the companies, ECBs of existing companies. And these ECBs are very, very large. They are not small by any measure. Multi-billion-dollar ECBs also we've seen. So the market, what this reflects is that there's appetite. If there's quality, there is confidence, there is appetite. In fact, the question that keeps coming back to us is, can we put in more supply? One of the ways in which to deal with the market exuberance is to just put up more quality supply into the market. And I think recently, even I'll expand, even some of the measures taken by SEBI in SM REITs, etc., I think some of them are pretty exciting opportunities for investors going forward. So I would say that it is across the board in terms of the offerings, old companies, new age companies, new business models. We've seen issuances coming from sectors that we've probably never seen before. Co-working spaces, something completely new, for instance. Electronic manufacturing, we didn't have too many of such. So there are issuances coming from internet type companies, consumer internet companies. So these are new models, new stories which are coming, which clearly reflect a very rich appetite, a diverse appetite, and the ability for different types of issuances, different types of corporates to come and tap the market.
So Ganeshan, you bring in the foreign perspective here, being part of BNP Paribas. Is this the view that is shared by the overseas investors, number one? And for a house like yours, are you diversifying your clientele to have more domestic? And obviously, Vishal did talk about mutual funds, insurance companies, pension funds. And what more needs to be done on that side? Because there the demand could be significant, the kind of numbers we are talking on the insurance sector or the pension sector now. It's only going to expand. Is it going to be different? And assume that, there is some correction. Will the IPO frenzy go down?
Yeah. No, so thank you very much for having me here. And thanks for your comments. So I would say that, look, I think we, as practitioners in the capital market for a few decades now, as Vishal said, we always saw a complementary flow between the foreign investors and domestic investors, because when one of them was buying, the other was selling, and vice versa. And probably the last 12, 24 months is the first time we are seeing both sets of investors buying in the Indian market. So I think just to put some numbers to this, and I'll talk in calendar year, that's what we have tracked and not financial, but the inflows into the Indian equity market was, peaked somewhere around 35 billion in 2020, and then it has been varying over the years, and there's net inflow. This year, calendar year 24, already in the first 8 months, we have crossed 38 billion. So I think just in terms of the context of the fund flow has changed. And what this has done is
So this 38 billion,
Yeah.
is it purely domestic or is it domestic and
domestic and FPI.
FPI? Okay.
Yeah. And I think what that has done is the size of the deals are also now increased. So I think just we looked at the data and said, what are the deals over 150 million, which is roughly around, let's say, greater than 1,000 crores. And 10 years back, if you look at it, the number of deals were in the magnitude of 10 to 15. And in the first 8 months of this year, we already had almost 68 transactions which were in this size. So what I'm saying is the type of investment has changed in the market. It is getting more institutionalized, which is what we see in most of the global market is, there is retail participation, but it's always via the mutual funds or some aggregator. And I think that is probably the direction which the Indian markets will also move. So obviously, it is a step in the positive, trajectory. Second, from a global perspective, when I look at it, I think India is definitely in a sweet spot. I think some of the factors were mentioned. I think good macro, stability of the government, stability of policy, very robust financial regulatory system and stock exchange system. And I think we have always been ahead of the curve in terms of disclosure norms, in terms of, the T+1, even as a global firm, I think I should say that, it was something that even our guys said, like, how can you think about T+1? It's not been kind of done anywhere else. So I think there have been some measures which, we have pioneered, and, it's in the positive direction from a investor perspective, which has increased the confidence of investors. So I think definitely, when we look at it, India is definitely in a sweet spot. Of course, in terms of concerns, I think, due to this fund flow, there is, always a momentum buying. And that means, the valuation today, though, we can justify through growth and the earnings parameter are, today, I would say a little stretched in terms of the valuation. So that is always a concern. And then if you look at the deal volume on the other side, a lot of and when we say deal volume, it includes things like block trades because, those are secondary sales by the market. So I think increasingly we are seeing a trend that even in IPO, a large proportion of the IPO tends to be offer for sale, which is, taking money off the table. So I think that mix between money coming into companies for capex versus, being sold as secondary by the shareholder, whether in IPO, whether in block trade, etc., has increased. So I think that is probably another trend to kind of see where, like how much of the fundraising is going into more building up productive assets.
So for the second round, I'll start in the reverse order. Though the next question is to you. So one of the points that was being made was this, that IPOs are priced to perfection. Is it possible? Or are you looking at greed and fear factors?
So look, I think all I would say is IPO valuation is more art rather than a science. I think it's always difficult to put a perfect model and say, this is what the price of the company should be. And, it's not due to the fact that, bankers are not doing their job or investors are not doing their job. It is an efficient market theory at the end of the day. So there is a buyer and a seller. And in fact, we have seen several situations where the investor says, he's not interested, at on day zero at price of, let's say, X. And then after 1 month, the price goes up 10-15%, and then, everyone is coming in to buy in. So I think it's difficult call to take, because, you're looking at a point in time, and then it's always, easy to, look at it in hindsight and say that, this was so obvious. So I would say that, the thing to really track is, what has been the performance of the IPO, of course in the short term, which is the day of the listing and 1 month, but also a little bit in the longer term, and see, how these IPOs are kind of giving returns to investor. I think the short term is more momentum driven, because, the listing day, trading, etc. is purely momentum driven. In fact, if you look at most IPO listings, on the first day of listing, the volume is always the highest. And in some cases, it can be, almost close to the entire IPO size, which means, that much of churn is happening. And investors, you have long investors who are investing for the long horizon. There are also investors who have, taking a view on kind of making a quick return. So you need all kind of investors to, in a market to make it perfect. But I would say, so long as, you're not kind of hyping the system to, to kind of, achieve a certain IPO valuation, and then, you see that in a 1 month, 3 months, 6 months time period, it never trades up to IPO price, then obviously those are the factors to look at.
Vijay, obviously the demand is good. The supply is also quite all right. But often this multiple of oversubscription, and we see this huge trend where HNIs and institutions, even the anchor book for that matter, is a huge multiple. But the retail is a much, much tinier number. Is it a function of liquidity? Is it hype? Or, or do you think people are just trying their luck for day one?
Yeah, so that's a very interesting question, sir. And probably this whole oversubscription and enthusiasm, and even the valuation that is coming, particularly in these reserved sectors which you mentioned, I'll probably just give a little bit of a backdrop as I respond to this. It goes into a sort of a maybe 2-year-old, if you zoom back 2 years into time, you'll find probably the market was still having a fair amount of tone setting, price setting taking place by the FIIs till at least 21 thereabouts. It is only from 22, 23 onwards that the pivot really was visible in favor of the DIIs setting the tone and price. And when we engaged with the FIIs versus DIIs on this matter, FIIs sort of thought process was that, we've seen this whole play, particularly for New Age when they were giving valuations, play out in the US and China, and we sort of can foresee the kind of growth that this is going to have. So they were more liberal with their valuation, and the DIIs on the other side felt that let's see cash flows, let's look at more fundamentals, and they were a little more guarded with the respect of valuations. 2 years down, and probably that explains how in the last 2 years versus now, the valuations have probably become more sober. Valuations today in a relative sense, we are seeing probably more sober than what even you would probably would have found 2 years back. And we track the returns that investors make on listing day for the main board. We also look at it, what happens 3 months down. And the average number is still okay, sir. See, for example, in FY23, the main board, what we've seen is the average return has been, FY24, has been about 27% on the listing day and more than 40% 3 months down. But one should not get carried away with averages, because hidden in that averages are certain exceptional cases where you had some massive sort of overperformance and certain places where you actually lost money. So the fact that the pricing today is giving this kind of a listing pop is, and the understanding of this is fairly deep with the various sections which come in the anchor book and so on. I think their participation is very enthusiastic. Retail, on the other side, I feel still has a understanding gap on or appreciation gap, and therefore I don't think it is to do with absence of liquidity. It is more to do with more education, understanding, and absence of the appreciation of the future potential business model. So cases which are well known, you've seen certain well-known consumer, huge oversubscription came up. Cases which are not so well known, more in the back end, but with great potential in the future. The retail probably is not so familiar with the brand, and therefore he doesn't have that full appreciation and understanding. So I think it's more to do with that. But valuation-wise, I think even now valuations are sober relative to maybe the secondary markets. And that explains why so much enthusiasm in the anchor book.
So on the issue of sobriety, do you advise your customers or a company who's issuing capital to keep something on the table? Or, I mean, who decides? Is it you or the investors or the company that is issuing? How do you arrive at that balance?
That's a great question, sir. I just want to add one more point to the last question, if I may. So, even in the public issue, the retail category is 35%. HNI is 15%, and the anchor plus the DI, FPI is 50%. That is another reason why you may see a little bit of undersubscription in the 35% being a larger category. But in absolute volume, it's still quite decent. But yes, it could do better. So on your question, it's a very tricky situation. So we meet all kinds of issuers. There are issuers who will...
Because the demand is so strong, he can demand any price. So does an investment banker or a merchant banker bring balance?
Yeah, so I'll be very frank with my answer, sir. Before any company that goes public, if you see the pitch books of any merchant banker, if there are 10 pitch books which are made by merchant bankers, I doubt any company goes public at those valuations. So in a race to win the business, you will always have the merchant banks give you a valuation which is pleasing to the issuer company and the promoters or the private equity firms. But it's not necessary that that is the valuation at which you go public. In some cases you may, but in most cases you don't. But I think issuers have become smart, especially the private equity investors have seen this game many times, not just in India, but all over the world. They do discount those numbers. But finally, sir, when we actually come to pricing of the IPO, I think it's a pretty evolved process now. Because once we file the offer document with SEBI, in a couple of weeks, the research analyst, he does his first rounds of meetings with all of the investors, domestic as well as international, a couple of the large family offices. And there is a good understanding of where a certain IPO may clear in a certain price band. And there is a very good sort of understanding and working environment between the different syndication desks of all the banks. And that has worked beautifully in the last 10 to 20 years, where the 3-4 merchant banks on IPO, they come together, the equity capital market syndicate desk, they share the feedback that they've got from the investors, and they actually correctly advise the issuer company on where they are seeing feedback on valuation. Once that is done, the client is taken to the investors. And Vijay made a very interesting point, which we are seeing in every transaction, where I think the domestic investor is now sort of setting the price on valuation, and he's definitely being more conservative compared to the foreign investor. And because the supply of capital is largely coming today from the domestic investor, I mean, mutual funds today have 1.5 lakh crores of cash, just cash balances. Total AUM, including ETFs, is touching 50 lakh crores in equity just for mutual funds. So I think they are being able to drive prices lower. But it's a very tricky situation, because what happens is when the IPO lists up 30 or 40 or 50%, the issuer always feels that he's left more money on the table. And there comes Ganesh's point that IPO pricing is never going to be a science, it's always going to be an art. So yes, from a merchant bank's perspective, to pitch to win the business, there is always a case of overvaluation. But thankful to all our partners and our syndicate desks, that by the time they go public, the realistic picture is out, using a science of working with the investors, giving that feedback regularly back to the issuer company, and really managing their expectation before they go public.
So we have very little time left, so now I'll start from the center. Vijay, the question is to you. We are speaking at a Fintech summit, and the Honorable Prime Minister spoke a while back. You think we'll get some traffic from there?
Sorry?
You think we'll get some IPO traffic from Fintechs, and what is the challenge there?
Yeah, actually, as we speak, we are working with a number of fintechs, as a banker, who are preparing up their companies to go public. I think starting from 2 quarters to 3 quarters from here, down to the next several years, we can see a big traffic of companies coming. One of them, of course, is a sponsor who's also preparing himself to go shortly. But I can clearly see from the type of conversations that we are having, a very, very healthy supply of new age companies, not just fintechs, but the expanded horizon of new age companies coming to hit markets. They are high growth companies, new type of business models. Many of them have now matured to a point of just showing growth, with showing growth and profitability, at least unit profitability, so that you're able to show path to profitability. So it's a very promising 2.0, I would say, fintech story that one can expect to see from the next few quarters.
Ganeshan, is enough being done for the retail investor?
Yeah, so, if you really look at the retail investor, I would say the focus from a regulatory point of view has, always been to protect, the kind of, most retail category of investor, and that we have seen over the years. So I would say that, in terms of ease of application, in terms of, the kind of trading, in terms of getting the allocations, I think there have been a lot of changes and a lot of improvements that have been done. So, yeah, I would say that, there is a lot done for the retail investors, and it's constantly evolving.
Vishal, the last one to you. So we've seen a start. We've seen a start of foreigners trying to list in India. And earlier on, they used to do a lot of delistings, but now the reverse is happening. And obviously, it tells you that everything is great as far as our markets are concerned. Your views over there, and especially, with things like MSCI, look at the way our share is going up, right? We are at almost 20% and going beyond. China at one point used to be 45. They are close to 24, 25. So that gap has also narrowed. So is there a message for us guys that, look, yeah, things don't look that bad in our markets, or they are very good?
No, absolutely. So I think on average in emerging markets, India is trading anywhere between a 25 to a 35% premium on the PE multiple compared to most of the other emerging markets. And I think India also is an excellent growth market from an economy perspective. So many of these foreign companies, as you rightly said, who will want to list here, their Indian businesses are doing extremely well. And that is the real motivation, that why not list the business here, get a larger, wider brand recognition through a listing, as well as access the domestic capital, which is growing in size, which today in India, in terms of our currency, it's not easy to move that much money abroad to buy the stock offshore. So that is, these are all the reasons why we will see a lot more listings of foreign companies in India, and this will continue, sir.
So thank you. Let's open the house for questions. Do we? Oh, you're running short of time. So thank you very much. If you want any takeaways, Vishal talked about the emergence of domestic players. The market is kind of agnostic to sectors. So it's not the tech or the financial sector that is going to drive, but the appetite is really big. Emergence of family offices and emergence of private equity. Vijay talked about the strong earnings, talked about the macros, the infrastructure, the growth, and the regulators having changed the way business is done, and that's why it is developing. Ganeshan talked about the complementary flows. There is still a decent amount of appetite from the foreign side. So, yeah, thank you very much, and do look forward to good quality IPOs from all the merchant bankers here. Thank you.
Thank you.
Thank you so much. Let's have a huge round of applause. Thank you, sir, for sharing these insights with us. Pleasure having you all here with us.